I've spoken a lot recently about the nature of Bitcoin bear markets and what the bottom usually looks like, and that the bottom is never really in until Bitcoiners experience max pain. Unfortunately, it is hard to fathom how things could actually get any worse. Maybe not for the price of Bitcoin, but for us Bitcoiners. If you have been so far off the grid that you have not heard about the cold card hack yet, please stop listening to this podcast right now and make sure your Bitcoin are safe. Don't act rashly. Remember, think before you act. As they say, slow is smooth and smooth is fast. We will obviously be talking about this in much more detail, and of course, we have our weekly DCA purchase to make. All ahead on today's episode of the Bitcoin Bulletin Podcast. This podcast is for information and entertainment purposes only. Nothing on this podcast should be construed as financial advice. All views expressed on this podcast are solely the opinions of the host and/or any guests that we might have from time to time. Nothing on this podcast should be construed as a specific inducement to make a particular investment or to follow a particular investing strategy. Guten Tag, Buenos Dias, Morgen, and welcome to episode 280 of the Bitcoin Bulletin Podcast. As usual, I am your host, Chris, and I'm coming to you from the Bitcoin Bulletin studio on Florida's beautiful Space Coast. However, I am hitting the road quite a bit over the next month or so. In fact, I'll be visiting at least 10 states, maybe more, so there is a possibility, or more likely probability, that at least an episode or two in the future might be either at a different time or maybe a little bit abbreviated, but we'll cross that proverbial path when we get there. I just wanted to lead off with that so that you'll be aware if things are a little irregular. We're not going anywhere. Our weekly Wednesday DCA stack will be made on time as usual, but the podcast might vary slightly in the next couple weeks. Of course, if you're following us on Twitter, where we are at BTC Bulletin Pod, you'll get heads up as to when those episodes are available or if there's going to be any major delays. Before we talk about anything else, though, I briefly wanted to talk about the cold card hack. It has been almost a week since the hack commenced because it started years ago, but it came to a head on a Thursday night last week. So a night and a half after the Bitcoin Bulletin Podcast, the last episode. So I wanted to strike a balance because the hack is still ongoing, even though it's not really breaking news for a lot of you. Every major podcast I listen to has already addressed this at least once, with more than a few major mea culpas from influencers who had been actively shilling cold card for the last several years, paid to do so, or maybe even invested in the company. But because the situation remains ongoing, and maybe you've been on a cruise for 14 days, for example, you might just now be learning about this, or I do know several people that were, they were aware of it, but they were in the middle of nowhere on a business trip, on a cruise, what have you. And so they didn't have access to their hardware wallet. So if you find yourself in that position, you need to make some very important decisions. All of that being said, my heart is breaking for those who lost Bitcoin to the cold card bug. The fact that you were going above and beyond to do everything right, that you had what was supposed to be, the most state-of-the-art cryptographically secure way to hold your Bitcoin private keys, that's why that hurts particularly bad. I mean, cold card, everybody said it's for advanced users. It has a bit of a learning curve. And so if you were a power user and you were a cold card user and you got stung, maybe that's why gut punch is particularly hard for me. So if you do hold your Bitcoin keys on a cold card and you have still not secured them, please take the time right now to educate yourself about what the current best practice is and move those funds before you do anything else. As of the time of this recording, the general advice is that if you have a cold card, any version, Mark 3, 4, Q, whatever, and you generated your seed by doing 100 dice rolls, you let the cold card generate the seed word for you or generate the initial entry for you, and then you manually entered 99 or 100 dice rolls. In theory, your Bitcoin is safe. I would not feel comfortable keeping any Bitcoin on any cold card device, at least not in a single SIG wallet. If you have a cold card Mark IV with 100 dice rolls that you're very confident is probably safe, and it's only one of 3 keys required to sign anyway, then you do you. Maybe you can leave your stack the way it is. Maybe at least bare minimum, you probably have some more time to make that decision. But if you have a cold card and you're using it as a single SIG wallet, regardless of what the model is, even if you rolled the dice, I would not feel comfortable that what we're being told is true, because as you know, what we've been told all along didn't pan out. And even though there's some independent eyes that have looked at cold card, looked at the quote unquote fix and said it's okay, you just never know. And even if you are certain, are you certain enough that you're not going to be waking up in the middle of the night to check your cold card balance 3 or 4 times during the night? And do you really want that kind of stress? Even if your Bitcoin's probably okay, it might give you peace of mind just to get cold card completely out of your flow. I'm obviously going to be spending a good deal of time talking about this in the news section, maybe explaining a little bit about why I think this happened, etc. But before we really get into all of that, let's take a minute real quick to look at Bitcoin's current vital statistics. At the time of this recording, we're sitting at block height 961,213, and Bitcoin's ringing in at a US dollar price of $64,650 per Bitcoin, almost $1,000 more than last DCA Wednesday, despite the fact that we had this devastating news. So that's pretty cool. With the minor exception, that means that because Bitcoin's more expensive, we're going to get fewer sats per dollar. Right now, every single US dollar that you convert into Bitcoin will score you 1,547 sats. That's exactly 20 Satoshis per dollar fewer than last Wednesday because the price is more expensive in US dollar terms. Bitcoin's current US dollar value gives it a market cap of 1.3 trillion, up from 1.28 trillion last week. So we've done a really good job of staying above that 1 trillion mark, something I've been eyeballing and talking about more frequently in the last several episodes. People talk about, was this the podcast that's the last time Bitcoin ever goes under 100,000, which obviously wasn't the case. But as we get closer to what would be historically the end of the bear part of the cycle, which is traditionally about 12 months after the all-time high, so that would be mid-October, as we get closer to that, if Bitcoin stays, every day that Bitcoin stays above $1 trillion US dollars is a likelihood that Bitcoin retains that 1 trillion market cap. We saw Bitcoin over 2 trillion during the all-time high, but 1 trillion is a significant asset. I mean, there aren't that many assets out there that are over $1 trillion. If you talk about the most valuable companies in the world, commodities like gold and silver, etc. So that's perhaps a bigger point than a lot of people are making, that we've retained, regardless of what the actual US dollar value is, we've retained more than $1 trillion market cap. In fact, on this episode, on this podcast, we haven't dipped below 1.2. I think the lowest we saw is $1.22 trillion back in June. So that is certainly encouraging and exciting news to me personally, knowing that Bitcoin is $1 trillion asset still, even in the depths of the bear market, even after a sucker punch like the cold card exploit, we still retained a $1 trillion market cap. Believe me, plebs, if the mainstream media, if the TradFi media, if the normies, if the Wall Street investors that have piled into Bitcoin thought that Bitcoin was dead, thought that Bitcoin is over, we would be significantly lower, and we would have lost that $1 trillion market cap by now for sure. For those of you who still value your wealth in shiny yellow rocks, it will currently cost you 15.3 ounces of gold to purchase just 1 Bitcoin. That's an extra 0.2 ounces of gold since last DCA Wednesday. So Bitcoin increasing its value in US dollar terms and in terms of what had previously been the hardest asset known to man before Bitcoin came along. And for those of you who value your wealth in something a little more edible, 1 Bitcoin will currently purchase you 3,615 large pepperoni pizzas from Papa John's. That is 1 pizza every day for just shy of 10 years, 9.90 years. according to the math on my calculator. And that is also really exciting because, if you remember, when Bitcoin was nascent, when Bitcoin hadn't ever been used for real world purchases up until that point in time when Laszlo made that first real world purchase, it took 10,000 Bitcoin to purchase just 2 pizzas. So it's all about perspective, plebs. And going from 10,000 Bitcoin for 2 pizzas to 3,615 pizzas for 1 Bitcoin, that's orders of magnitude. And that shows you just how far we've come. Even though if you bought in at the all-time high, it's certainly easy to understand why people might think that Bitcoin is tanked or even over. The Bitcoin obituary list continues to grow. That metric that has been my favorite metric to follow the entire history of this podcast, of course, is Bitcoin's 24-hour on-chain transaction rate. I modify that with on-chain transaction rate because this only measures transactions that are mined to the Bitcoin blockchain. It doesn't include transactions like when you go to Steak and Shake and buy a steak burger and some tallow fries with your Bitcoin over the Lightning Network, or if you're using Liquid or some other side chain. Nonetheless, we're currently seeing 6.69 transactions per second on average, which is down a little bit from last week's incredible 7 transactions per second, but still higher than we were the 2 previous weeks in a row. And that is particularly encouraging, that there's still robust Bitcoin use going on, despite the fact that we're in a lull right now where people are depressed about Bitcoin, and the transaction volume probably spiked while everybody was migrating their Bitcoin off their cold card wallets. But that was days ago for the most part, and we're still seeing robust on-chain activity today, even almost a week later. So that is really cool. And of course, speaking of that on-chain activity, the mempools are looking about the same as they did last Wednesday. Clark Moody's more restrictive traditional mempool is showing 1,648 pending transactions, less than 1 full block, where mempool.space with their more liberal mempool settings are showing 90,982. So Clark Moody's dashboard showing almost the same number of transactions as last week. Mempool.space actually showing about 2,500 more transactions, but still relatively in line because, that number can swing by 3,000 or 4,000 transactions just when a new block is mined, depending how long it's been since a block is mined. So 90,000 and 88,000 are effectively the same place, unless you were really, really, really getting specific. Despite the fact that we're still seeing a robust amount of on-chain activity, it is still incredibly cheap to do an on-chain transaction. I was in the situation where I had both a Cold Card Mark III and a Cold Card Mark IV, and I moved my Bitcoin. It's more secure now. I don't want to dive into my personal security setup, but I moved all of my Bitcoin, and I had many, 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 many UTXOs. So the data size of my transactions were very large because I was bundling lots of little transactions into 1 or 2 big transactions. But I still was able to do so for, I think, less than 1,000 Satoshis. And that is because despite the activity, a high priority transaction still requires a fee of just 2 sats per VByte. And both Clark Moody's dashboard and mempool.space are making that estimate of 2 sats per VByte. And they were recommending 3 sats per VByte when I moved my Bitcoin. And I did 1 transaction for 1 sat per VByte and 1 for 2 sats per VByte. So I undershot on both of them. I lowballed both of them, and they still got mined in the next block. So these stats ebb and flow as well, because if it's been like 45 minutes since the next block, the algorithm's going to notch up the amount it thinks you need to spend. And then, of course, the next block comes in, and a block comes in after that. And all of a sudden, they're back to half sat per VByte transactions being mined. So if you are doing a priority on-chain transaction, make sure you look at least one, preferably more than one source, so that you have the most up-to-date picture of what it's going to cost you to move your Bitcoin. But plebs, even at 2 sats per VByte, taking into account the size of the average Bitcoin transaction, multiplying that by the 2 sats per VByte, and then extrapolating the US dollar value of those Satoshis, it's just going to cost you 14 cents. 14 cents for a priority transaction that you can send anywhere in the world at the speed of light, and that nobody can stop you. Nobody can claw that transaction back. And that is just incredible. It's really astounding, especially if you've been in Bitcoin for a while and you remember when fees were really high, like in 2017, and it would cost you $50 or $60 for a high priority transaction. And if you didn't pay that fee, forget whether it was a low priority transaction or not, it just flat out wasn't getting mined. And so we've come a long way. And then when you look at how much it costs to wire money to somebody, particularly, in a lesser developed country, it's going to be very, very, very expensive. And we're talking just 14 cents to send Bitcoin. So that's one of the Bitcoin's strongest characteristics is not only is it fast, not only is it permissionless, it settles within the next block when it's mined, as opposed to, 7 business days or longer for a wire. And it does so for so cheap. That's just mind-boggling. In my personal business, I have done numerous overseas transactions. I've ordered equipment from all over the world, including like China. And you always have to wire the money there. And the last thing I ordered from China, it took 30 days for them to receive the wire and ship the equipment I was buying. 30 days, and it cost me over $100 to do that wire, which was just nuts. We are getting closer to the next Bitcoin mining difficulty adjustment. Mining difficulty is adjusted every 2016 blocks, which works out to about once every 2 weeks. It's block time, not human time. So if blocks are coming in faster, it's faster than 2 weeks. If blocks are coming in slower, it's longer than 2 weeks. But if they're coming in exactly once every 10 minutes, which is the goal, it works out to about 2 weeks. And we're just 419 blocks away from the next mining difficulty adjustment. So that's about 3 days, a little less than 3 days from now, probably on August 8th. And last 2 episodes, it was looking like that was going to be a difficulty decrease because it appeared hash rate was falling off and, blocks were slowing down, but, things change. I often say when we're talking about the statistic that, a lot can happen between where we are now and when that difficulty adjustment is actually made. And that has happened. Instead of looking at a 4.9% difficulty decrease, we're looking at a modest increase, anywhere between 0.34 to 1.5%, depending on who's doing the estimation. And that is because blocks have obviously sped up. They're coming in at an average now, this difficulty epoch, of once every 9 minutes and 53 seconds. Obviously, that's too fast for the algorithm, so it's going to, if that continues, Bitcoin will adjust that difficulty upward to try and slow them down to shoot for that 10-minute mark. And as a result, the estimation of how much computing power is securing the network has also gone up. I went into this in a little more detail last episode about how you can't really tell how much computing power is securing the network. All you can do is make an estimation based on the known difficulty and the average block time. And sometimes there's reasons miners shut down for a short period of time, but it doesn't mean they're quitting and they come back online. And that appears to be the case because the 90-day estimate of hash rate is coming in at 933.7 exahash. And the 2016 block estimate of hash rate is coming in at 914.4 exahash. And that's up 40 exahash from last DCA Wednesday. So again, these are all just estimates, but regardless whether it's 933 or 914 exahash or whatever it is, when we first started doing this podcast a little over 5 years ago now, the hash rate was estimated to be about 85 to 90 exahash, and the network was already the most secure network ever known to man. Inconceivably difficult, impossible really to attack. Trying to do a 51% attack by putting enough hash rate on the network to try and rewrite a block or whatever. And now we're 10x that. So, whether Bitcoin ebbs or flows by 40 or 50 exahash here, plus or minus, it's really irrelevant as far as the security of your Bitcoin is concerned. Real quick, I want to take a minute to thank those of you listening on your favorite Podcasting 2.0 apps, such as Fountain. Podcasting 2.0 is a Bitcoin native way to listen to podcasts, and as such, allows you to contribute value back to this podcast by either streaming sats as you listen on a minute-by-minute basis, or by sending a boost, which is a shout-out via a Lightning transaction. But because it is a Lightning transaction, in addition to saying, hey, you are sending Satoshis back, you're contributing value back to this podcast in the form of Satoshis. Those are you do you things. If you want to stream sats while you're listening because you think you're just getting 1 sat per minute worth of value for listening to the podcast, then you can stream 1 sat per minute. If you want to stream 100 sats per minute, that's up to you. And likewise, the value of the boost you want to send. But that is really cool. And then when we do get boosts from our listeners, of course, we read them on the next episode. And we have a booster read this week. Leggy, a longtime listener, boosted the show 2,000 Satoshis last episode and said, "Hello, Chris. Congratulations for enduring 5 years. I'm listening less podcasts, so I just got to know that John Dvorak passed away, and somehow that has hit me really hard. Never expected to feel like this for someone I've never met. Thanks for your work." That was surprising. I mean, I guess it shouldn't have been surprising as it was, because he wasn't a spring chicken, as they say, but it was shocking, and I know it was quite a gut punch. Of course, maybe not as much of a gut punch to some of you who just had your wallets swept, but yeah. So thank you for the boost. Thank you for the kind words. Thank you for the eulogy for John Dvorak, and may he rest in peace. All right, back to the news. Of course, the news of the week remains the cold card exploit. Now, the cold card exploit, for those of you who don't know, basically, when the software was rewritten, and we're going to get into that in a little bit more, so I don't want to get too far ahead of myself, but when the software was rewritten, when they took cold card from a free and open source software to a closed source software, or to not quite closed source, they came up with kind of a mid open source viewable, but you couldn't use it for commercial purposes. Nonetheless, when they did that, apparently there was a bug where the device ignored the 256-bit entropy that it was supposed to generate, and you ended up with only about 40 bits of entropy, which was something that you could brute force with an iPad in a relatively short amount of time. And this went undiscovered for like 5+ years until it wasn't undiscovered. Now, there are some suggestions out there that there had actually been exploits occurring little by little for the last couple of years, but they were often just kind of blown off, like, you just messed up your dice rolls, or you didn't know what you were doing, or you told someone you stored your seed insecurely. And that might be the case. But what we do know was last Thursday night, all of a sudden, a major exploitation of this bug occurred, and thousands of people lost their Bitcoin. Hundreds of Bitcoin were swept off of wallets. So again, reminder, if you have a cold card, any model, and you still have Bitcoin on them, especially if you didn't do dice rolls, or if you don't remember how many dice rolls you did, or if you did them at all, maybe you did 5, 10, 15 dice rolls. If you're not certain you did, the official advice now is 50 or more dice rolls, but I would say 99, 100 dice rolls. If you don't remember for certain that you did 100 dice rolls, my personal advice is, if your Bitcoin hasn't been swept yet, get it the heck off a cold card. And remember, don't panic in doing so. Make sure you know what you're doing, because oftentimes Bitcoiners' biggest risk is themselves. You end up foot-gunning yourself, so to speak, and end up losing your coins. So keep that in mind. As I say, slow is smooth, and smooth is fast. So how big is this hack? Well, it's a lot bigger than it was estimated last Friday. Apparently, there have been 4 different waves of sweeps now. Currently, the estimate is 1,816 Bitcoin have been stolen, with an estimated US dollar value of $116 million. More than 5,200 addresses have been swept in 4 confirmed waves that are still ongoing, mind you. But and I saw some big Bitcoin sweeps. I think the largest transaction was around 55 Bitcoin, but the vast majority of them were less than 1 Bitcoin, a tenth of a Bitcoin, a quarter of a Bitcoin, which to me says it's plebs, people like you and me, probably people listening to this podcast that have lost their Bitcoin. And that's why it's the gut punch. That's why it is, if Michael Saylor had lost 1,000 Bitcoin, it wouldn't be that big a deal. Probably wouldn't even move the price of Bitcoin, but it wasn't Michael Saylor. It was the little guy like you and me. And that's just unforgivable, because, well, I'm getting ahead of myself again, but this was obviously preventable. So how exactly did this happen? Well, my opinion is that this was the result of hubris. If you remember back in the day, NVK was absolutely furious that basically he was accusing Foundation with their passport, the Foundation passport, of cloning, making a clone of their code. And a lot of people pointed out, well, hey, NVK, you copied most of your code from Trezor, which was free and open source, and he had the right to do so, just like Foundation had the right to copy his code. But he was pissed. And so he hastily rewrote everything from scratch so that he could take it private, make it proprietary, so nobody would ever rip off his technology ever again, even though, like I said, he was using Trezor technology. But in that rush, they obviously screwed up big time. Zach Herbert summarized this last Thursday, just when the nature of the hack was becoming clear. And I'm pretty sure this tweet has been deleted now. I have screenshots, so I'm going to read you the post because I don't think it's there anymore. But he was at Z Herbert on X, so it's Zach Herbert, and he posted regarding the cold card entropy bug. Many folks are explaining what happened, but I wanted to take a minute to explain why it may have happened. It is a disastrous situation, and our heart goes out to all the Bitcoiners affected. Here's a timeline of the events. On July 28th, 2020, at Foundation HQ announced our first Passport hardware wallet and noted that we were building on cold card firmware, which at the time was GPL v3 licensed, free and open source software. On July 30th, 2022, NVK publicly said he regretted choosing GPL because cold card now had a clone and that they would change things in the future updates. Then on November 18th, 2022, so just a few months later, cold card added its MIT Plus Commons Cause license, prohibiting commercial products substantially derived from the software. On January 8th, 2021, cold card firmware 3.2.1 formally announced license changed to GPL from GPL to MIT Plus CC on files for which the GPL doesn't apply. CC is the Commons Clause license addendum, which is source available instead of FOSS. On March 1st, 2021, the first pass with libNGU commit removed the GPL Trezor-derived crypto libraries and replaced them with the libNGU. That same 120-file commit changed the seed generation code. And that's key, plebs. libNGU was licensed with a novel licensed for Bitcoin-only license. On March 18th, 2021, version 4.00 announced that all crypto and BIP39 code had been replaced and that the last remaining GPL code was removed. Our best understanding right now is that the entropy bug was collateral damage from this major overhaul of the codebase. To be clear, this overhaul was not solely about licensing. Cold Card also cited technical goals, including adopting Bitcoin Core's libsec 256K1, faster AES and SHA implementations, and reproducible builds. But the timeline establishes two things. First, Foundation's launch was the obvious impetus for Cold Card's licensing change, and two, removing the remaining GPL code was an explicit goal of the subsequent v4 rewrite. We don't know by how much the licensing pressure affected the scope or timeline of the rewrite. All we can determine is that the entropy bug was introduced inside the same 120-file commit that removed the old GPL code dependencies. So again, this tweet has since been deleted, but I have the screenshots, the receipts, as they say, and that was reasonable insight. And it goes along with my opinion that a lot of this, I think, falls squarely on the shoulders of NVK for his hubris, for thinking that the code that he borrowed from Trezor and modified, well, nobody else had the right to do that with his code, even though he took full advantage of free and open source software. And as a result, in his rush to cushion his ego, he screwed thousands of plebs out of their Bitcoin. I've talked a lot in the last couple episodes about, how the bear market never ends until we have a major capitulation event, like, last cycle with the FTX failure, etc. And I've spoken about this cycle with the treasury companies, some of them folding, at least dumping their Bitcoin or a lot of their Bitcoin. BitMEX shutting down. And of course, last week we spoke about the pool in bankruptcy. And I mentioned that, quote, previous cycles have tended to ink their bottom only after a big capitulation event, which was often only after a cascading series of these sorts of collapses. So what I was saying there was that we were seeing the beginning stages, but this might not be the end, that normally this sort of thing builds, it snowballs like an avalanche. The first patch of snow to fall off the cornice might only be a shovel full of snow, but by the time it gets to the mountain, it's deadly and destructive. And even now, with this big black swan event of Cold Card, we shouldn't assume that the worst is over. But I think we're definitely in the end days of the bear market because we've definitely had that black swan. The important thing is to first make sure that your Bitcoin is safe. And second, to keep taking advantage of the incredible price range that Bitcoin is in when we're in this deep value range and grow your stack. And I know it's not any solace, but if you lost your Bitcoin, better to lose it at the low than at the all-time high. I mean, it's going to be, I know, almost impossible for almost everybody to get back to where you were, but at least it's not as hard as it would be if Bitcoin were $200,000 a coin. Along the lines of price, Adam Meister at TechBald on Twitter gave us his assessment of the cold card exploit on Friday when he tweeted, "The cold card situation is the worst thing to happen in the Bitcoin space in a long time. The worst event of the decade in Bitcoin. No big price drop. Shows how few people entities care or know about being your own bank." So why didn't the price tank? Well, it may be that big Bitcoin just doesn't give a flip about holders losing a few coins. In the grand scheme of things, it wasn't anywhere near as much money as lost by FTX or lost to Mt. Gox. Or it could be that Bitcoin is already under such price pressure because we've been in the bear market for so long. The price is so low, it's already in such a deep value territory that, how much lower can it go, right? Or maybe it's a combination of the two, but I am certain that if we were in the middle of a bull market, if we were nearing new all-time highs, for example, the never Bitcoiners, the Peter Schiffs of the world, the less friendly media, well, obviously they would have made a much, much bigger deal about this, and it definitely probably would have had a much heavier impact on a frothy price, maybe caused a significant pullback, and it didn't. So there's some light at the end of the tunnel. In my opinion, though, this was definitely the black swan that I had been talking about. Nobody has a crystal ball. It's just every cycle has one. But that doesn't mean it's over. Just like Celsius was a black swan, Terra Luna, BlockFi folding, it wasn't until months later when that avalanche got big and it brought FTX down that we really, really had that final capitulation. Of course, there's also already been some fallout from the cold card exploit. Nothing dramatically cascading, but the ensuring hackathon has been pressuring Bitcoin-related businesses. Cointelegraph reported on Monday, Boltz suspends Bitcoin swaps amid surge in AI-assisted attacks. Bitcoin swap service Boltz has suspended operations as AI-assisted attackers are finding and adapting exploits faster than its developers can patch them. My first clue to this is I run my own Lightning node, and one of the channels I have is with Boltz because, Boltz is a great tool. It was a great tool for swapping your Bitcoin out of your Lightning channel and back to your Bitcoin on-chain wallet without actually closing any channels. If you're balancing channels, or you just want to, if you've got more Bitcoin tied up in Lightning than you felt was comfortable, Boltz is a great way to get it off without handicapping your Lightning node's capacity. So. I woke up and saw that I had a confirmed channel closure, and I was, I wonder what's up. And apparently that's what it was. But getting back to the whole, why did this whole thing happen? Why are we where we are? There's been a lot of speculation, and Bitcoiners in the Bitcoin space, especially Bitcoin Twitter, they love a good conspiracy theory. The flat earthers, the ice wall theories that we've never been to the moon type theories, they get a lot of sway on Bitcoin Twitter. So it seems logical that would be the case with this hack as well. And also there's some fuel to throw on those fires. So for example, Michelle Weekly commented on an old post saying, "At Grok, what are the mathematical odds that Cold Card would make this joke and then the exact scenario they're joking about would turn out to be true a few years later?" And Grok said basically statistically zero. And what she was referring to was a tweet thread from October of 2021, when Cold Card was announcing an update with their dice rolls, and they said, "Cold Card makes retirement attacks impossible. Generate your own entropy and reproduce it provably." And that led a user to say, "What is a retirement attack?" And Cold Card said, "It's when the project makers have a bug in the entropy generation for later retrieval," i.e., a retirement attack, meaning you develop some software, you put a bug in it that you hope will be overlooked, and then when you've gone long enough, the jig is up, you want to cash out and retire rich, and so you exploit your own bug. And so then Michelle Weekly chimed in with her tweet saying, "What are the odds?" Cold Card's joking about this sort of thing, and then it happens. And there's more than one coincidental post that people are pulling up from back in the 2021 era that's certainly come back to bite them in the butt. NVK and Cold Card have gone on a tweet deleting spree. So most of these tweets are deleted or disappearing rapidly, but fortunately, Bitcoiners have receipts. Despite all the doom and gloom, there is positive news out there. It always gets darkest before the dawn, and it always feels the most like Bitcoin is over. The most people have that biggest sense of capitulation, right as the bear market is really ending. And worst case scenario, if we rhyme with last cycle, we will see our cycle bottom sometime in October. And then Bitcoin isn't going to shoot back up. We had that the bull crab market where Bitcoin slowly ground higher until just before the all-time high, and then it really surged. Before the next halving, and then it set the new all-time high before the halving, and then just went, ballistic to over 100,000. But the 2028 halving is coming sooner rather than later, and just like this podcast, it seems like it was just yesterday, but it's been more than 5 years now. And just like, it seems like Christmas just happened, but we're over halfway through the year again, and Christmas is coming up. The long, hot summer is coming to a close in just another month or so. As such, so will, this halving cycle, and we'll have the next halving, and it will all begin again. And in the meantime, you have a tremendous opportunity to stack cheap sats. But another example of positive Bitcoin news is that the buy pressure from the ETFs are returning. We had seen a couple of weeks of outflows, people selling their ETFs and the ETFs selling their Bitcoin. But in the last 2 days, we've seen over $200 million in net inflows into the Bitcoin ETFs, primarily into BlackRock's IBIT ETF. On Monday, there were 170.1 million in inflows, so almost 200 million. And then on Tuesday, there were more than 200 million. $211.5 million of the positive inflows. So week to date, and we only have the data through Tuesday, just the first 2 days, we've already seen $381.6 million flow back into the ETFs. So pretty respectable turnaround after, some previous weakness, and unexpected because, if this Cold Card hack were the death knell for Bitcoin, if this was the end of Bitcoin, if Bitcoin was truly going to die, you wouldn't see normies pouring into ETFs. So that's pretty encouraging. Most importantly, though, it's not just the dollar amount. It's not just that 381.6 million. That translates into about 3,288 Bitcoin. Plebs, that's 7.3 days of newly mined Bitcoin supply being absorbed in a single trading day. I'm sorry, that was just Tuesday. That was just yesterday's. So, of course, the 170 million on Monday soaked up another couple thousand coins. So, maybe almost 2 weeks of newly mined Bitcoin supply being soaked up just by the ETFs in 2 days. And more than enough to make up for Michael Saylor, who had been previously stacking thousands of Bitcoin every week. And then last week we noted that it was the 5th week in a row that he had not stacked Bitcoin, instead focusing on accumulating cash to make sure he had enough money to pay his dividends on his Bitcoin yield products. Well, this week, it got a little worse. They took a pretty big step backwards, in fact, actually selling a substantial amount of Bitcoin. In fact, Strategy sold 1,638 Bitcoin. Although, to put that in perspective, that's less than half of the Bitcoin that the ETFs purchased yesterday alone. So isn't it amazing that when, we always talked about Wall Street getting involved in Bitcoin on the path to hyper-Bitcoinization, and now they're solidly involved. And now they're buying 1,000 Bitcoin here, selling 1,000 Bitcoin there, and it's not even swinging the market. So Saylor tweeted about this, conveniently kind of leaving out the fact that they sold Bitcoin when he did his weekly post. Every Monday he posts an update on Strategy's holdings. And this Monday he posted, Strategy has increased its US dollar reserves by $525 million, achieving 2.1 years of dividend coverage. As of 7/26/2026, we hodl 843,775 Bitcoin. I am reading you the wrong tweet. That is last week's tweet. Let me find his current tweet because it's quite telling. He left out the fact that they sold, and he instead focused on their cash aspect. So what he posted was, Strategy increased its US dollar reserve by $250 million and repurchased 81 million of Stretch. This increased USD duration by 57 days to 2.3 years and tightened Stretch's BTC credit by 5 bips. As of 8/2/2026, we hodl 842,138 Bitcoin in our BT reserve and 4 billion in our USD reserve. And there you have it. Since I accidentally read the old tweet of 843,000, the smoking gun is they currently hold 842,138. So neglecting to mention he sold Bitcoin, but he, included the number, so it wasn't an out. Whether you want to call it an omission or not, he at least didn't highlight it. I mean, the numbers there, if you're paying attention, you can see that's decreased. So, fortunately, though, similar to the cold card news, this sale didn't budge the price of Bitcoin at all. If at least it didn't appear to. Maybe that's because the ETFs more than soaked up the slack, but the point being, we're having these big swings in Bitcoin sales or purchases, and it's completely unaffecting the price of Bitcoin, which is not necessarily something that's completely because the size of Bitcoin's market cap, but I think also because it says that the market is priced in that the price of Bitcoin right now is a good price, a sale price, that, Bitcoin there's no justification for Bitcoin being any lower. And it's holding the line even in the face of large Bitcoin sales. At least that's what I take away from it. The sale did, however, have the result that Saylor was apparently looking for because, STRC, their 12% now annual yield product, was supposed to have a par value of $100. That was the goal of keeping it trading at exactly 100 per share, and it was trading in the 80s, as low as the 70s at one point in time. The price absolutely tanked, and the price soared recently, with CoinDesk reporting just a couple hours ago, Stretch surges 30% from its June low to $94 as Strategy sells Bitcoin to fund dividends, repurchases 106 million in preferred shares, and builds its US dollar reserves to 4 billion. So Saylor shoring up his strategy, which I guess is important if you don't want MicroStrategy and these products to fail. If Saylor is right and the financialization of Bitcoin is the future, he's only the first person really to do it. I mean, there's Strive doing it also, but it's new territory still, all things considered. And if it succeeds, obviously there's going to be more copycats, and that will have positive price pressure on Bitcoin. So from that aspect, the fact that Saylor was able to prop up his Stretch, all he has to do is prop it up through the bear market, and the euphoria of the next bull market was going to make it successful anyway. So potentially good news. You make of it what you will. All right. It is officially time to move on to our dollar cost average segment. What is dollar cost average, you might ask? Well, dollar cost average, or DCA, is an investment strategy where you invest your money in equal portions at regular intervals, regardless of price. For example, we started dollar cost averaging more than 5 years ago. We decided that we were going to start purchasing just $20 of the Bitcoin every week. So our equal portion was just $20, and weekly was our regular interval. These are both you do you things. I chose $20 because I wanted to keep it simple. I wanted to keep it relatable. I wanted to show that even if all you have that you can scrape up to put away for your future is just $20 a week, that it would add up fast, and that you're not too late. But again, it's a you do you thing. If you're Michael Saylor, obviously you're not going to buy just $20 a week worth of Bitcoin. So those are decisions you have to make. And if you are stacking more than $20 a week, well, then you're doing even better than we are. So today is going to mark our 263rd weekly DCA episode. We've stacked $20 a week for the previous 262 Wednesdays, which means that already we've converted $5,240 into a stack of $12,160,000 129,103 sats. So what does that mean? Well, if $20 is a lot of money for you, if you're struggling to come up with $20, imagine having a nest egg where you put 5,240 into savings. That's the point about showing how that part adds up fast. But more importantly, the number of Bitcoin you had add up fast. Now there's 100 million Satoshis in every Bitcoin, so that a little over 12 million sats means we have 0.12129,103 Bitcoin, worth substantially more than the 5,240 that we put into it, even though the price of Bitcoin is near its cycle low. And that's actually really incredible. I mean, our average cost basis is just $43,201.88. So basically $20,000, $21,000 cheaper than what the price of Bitcoin is, even with the price of Bitcoin being down. Even with the price of Bitcoin near the capitulation levels, below the previous all-time high, the previous cycle's all-time high, we're still sitting pretty. And we did all of that by ignoring price completely and just plugging away consistently every week, just $20 a week, regardless of price, over and over and over again. Time moves mountains. And as they say, time in the markets beats timing the markets. We didn't try and gamble on price. Therefore, we didn't get, FOMO in at the top and be those people that are stuck with an average cost basis of $100,000 or $120,000. And even they're going to be okay after the next bull run. But $43,201.88 is a very enviable average Bitcoin purchase price. And we did it all without trying to time the market. We've already made this week's stack because I automated our purchase with Strike, because Strike allows you to stack for free, no fees whatsoever, if you set up an automated purchase. So that was just too good to be true. Not too good to true, too good to resist, too good to turn down. So many months ago now, we moved from Cash App to Strike. Neither Cash App nor Strike are or have ever been sponsors of the podcast. We have no sponsors of the podcast. Part of the reason why it's nice to see Fountain offering the ability of people to contribute value back, so podcasts like mine can continue without having to sell our soul. Because I can only imagine how horrible I would feel had I taken a sponsorship from a company like CoinKite and gotten paid every week to promote the cold card and have to share in that responsibility and that guilt trip. Nonetheless, we automated our purchase with Strike, and so they've already made that stack. They did so right about the time I hit record. And at the time, Bitcoin was worth $64,758.45 a coin, about where it's at right now, looking over at my brains deck. That means our $20 got us 30,884 sats, less than the 31,188 sats last week, but that's the nature of the beast. As the US dollar value of Bitcoin goes up, the fewer Satoshis you're going to get for each dollar. Obviously, when we hit $100,000 again, instead of getting 1,500, 1,600 sats per dollar, that's the point where you're only going to get 1,000 sats per dollar. And that at a million, you're only going to get 100 sats per dollar, and so on and so on, until no one's willing to even sell you a Satoshi for a US dollar. Nonetheless, while people are still willing to sell us Bitcoin for worthless paper, those 30,844 sats brought our stack up to 12,159,987 Satoshis. And it did increase our average purchase price, because obviously anytime we buy Bitcoin at a price higher than our average cost basis, that average cost basis is going to go up. But it only went up by about $54, almost $55. Our new average cost basis is now $43,256.63. Again, a really enviable average cost basis, even at the Bitcoin price of $64,000 a coin. Certainly a price people will be calling you lucky when Bitcoin reclaims its $126,000 all-time high and goes on to set its next all-time high. Because as Adam Meister so famously says to the intro to every one of his podcasts, when he does them less often than he used to, we're just one day closer to that next all-time high. Bitcoin always returns to its all-time high. So when Bitcoin does reclaim its all-time high, well, before then, when Bitcoin retakes the $100,000 mark, our current stack, despite the fact that we've converted just $5,260 into Bitcoin, our current stack will have a US dollar value of $12,159.98, more than double what we've put in. When Bitcoin goes on to hit that $1 million mark, which it will sooner rather than later. If you'd asked me 5 years ago, I would have said it probably would have hit it in the bull run after the 2028 halving. Maybe it does, maybe it doesn't. Maybe something happens to spur on hyper-Bitcoinization. We get that gradually then suddenly thing and it happens sooner. Maybe it happens later. But eventually it will. And when it does, our humble stack, even if we don't make another purchase between now and then, will have a staggering US dollar value of $121,599.87. Again, for an investment of just $5,260. And plebs, if $20 a week is all you can afford to put into Bitcoin, then imagine having $121,000, almost $600 put away for your future. Night and day. Life-changing money for someone who only has $20 to their name. Of course, Bitcoin will go a lot higher than that. I believe Bitcoin's an all or nothing proposition. Either we achieve hyper-Bitcoinization, Bitcoin becomes the largest global reserve asset, or it fails. And the longer Bitcoin goes on, the more attacks it survives, the more setbacks it survives, the more black swans it survives, the less likelihood that failure is, and the more certain hyper-Bitcoinization becomes, at least in my opinion. Of course, Adam Back, who is referenced in the white paper, certainly in Cypherpunk OG, he said back in 2022 that his prediction was that by the 2032 halving, Bitcoin will eclipse $10 million a coin. And when that happens, whether it's in 2032, whether it's sooner, whether it's a little later, our humble stack will be worth more than $1 million. $1,215,998.70. Those are Nancy Pelosi level returns for an investment of just $5,260. And if all you have to your name is $20 a week, imagine having $1,215,998 saved for your family's future. But Bitcoin will go higher than 10 million. Fidelity, they're big believers in Bitcoin. When Fidelity Investments Director of Global Macro made their prediction back in January 2022, they said that by 2038, they predict Bitcoin will be worth $1 billion. Billion with a B. And when that happens, our humble stack will be worth a staggering $121,599,870 US. Maybe private island money, depending on where the island is. Maybe private jet money. Definitely life-changing money. In my opinion, and for my family, that would be generational wealth. And plebs, if you've been stacking double what we're stacking, you'll have more than that. If you've been putting away, $100 a week instead of $20 a week, you'll have 5x what we have. But even for just stacking $5,260 now, the insane profit that you would have turned at 121,599,870. It seems unbelievable, right? But I've been a Bitcoiner long enough now that, I remember when Bitcoin broke 1,000 for the first time, and, a lot of people sold. They thought that's as good as it's going to get. When Bitcoin hit 20,000, people couldn't believe Bitcoin ever got that high. And then, people were saying, well, Bitcoin's going to go to 100,000 next. And naysayers were like, there's just no way. Peter Schiff had that famous tweet, Bitcoin will never go to 100,000. And of course it did. Now, Bitcoin going from 1,000 back in 2016, 2017, even the beginning of 2017, up to 100,000 is 100x. Well, at 60,000, 64,000, a humble 10x is 640,000. Talking 1.28 million if Bitcoin 20x's. Well, Bitcoin likes to 100x, and whether it does it in one cycle or whether it does it in 2 or 3 cycles, to me, it seems like the math is undeniable. Either way, though, plebs, remember, it isn't the money that we're in this for. It's nice that we're early adopters, and plebs, you are still early. Even if you don't think Bitcoin's going to go any higher than the previous all-time high, maybe it goes to 150 and stops next cycle. Well, 64,000 to 120 is still doubling your money. So by those terms, you're early, because there aren't a lot of investments where you just know you're going to double your money, even if Bitcoin only performs blasely. If it only goes back to its all-time high, it doesn't have to get face melting to be an incredible return. But it isn't just the money. That's just a nice bonus. Remember, we're Bitcoiners because the current monetary system was designed to screw you over. It was designed to make you trade hours of your life for paper, pieces of paper that they print for nothing. The Federal Reserve prints money. They give themselves a commission for printing money, And when they do so, the US dollar hasn't devalued yet. It still has that same spending power. So that's the cotillion effect. The people closest to the banks, closest to the money printer, they print themselves money, they buy themselves yachts, they buy themselves equities. They don't hold those dollars. They buy stocks or gold or even Bitcoin maybe. And then when the money filters down to you and me and the average person, then you get inflation, you get the devaluation of the dollar. And what that means is they've stolen hours of your life. And Bitcoin fixes this. Bitcoin means you don't have to get permission from a government to use your money. Even if you're not in the third world. Remember Canada just a couple of years ago when the truckers decided they were going to protest the COVID lockdowns, the COVID mandates, and they just parked some trucks near the Capitol. And as a result, they had their bank accounts frozen, their car registrations, and their insurance canceled. They couldn't even buy a Happy Meal at McDonald's. Well, no government can do that with Bitcoin. They might be able to put your Bitcoin on some list and say naughty, naughty to anybody who takes that Bitcoin, but they cannot stop it. Just like with free speech in the United States, the Supreme Court has the ruling back in the Pentagon Papers days of the Nixon days about prior restraint. In this country, we have the right to say it. You can say whatever you want, even if what you say is illegal and you can get arrested for saying it. They can't prevent you from saying it in the first place. They can't stop you. Now, that's a force of law, not a force of mathematics. And Bitcoin is a force of mathematics. So we don't have to rely on the good graces of government. But the point being, we're Bitcoiners because Bitcoin is the first fair, honest money that we have had in our lifetime. And we're still early adopters. So things are only going to get better for us. All right. That is going to wrap it for this podcast. I hit the road in just a few hours. So I will probably I'll probably be at least back or hunkered down somewhere before next Bitcoin Bulletin podcast. So I don't anticipate that there will be any issues with getting the next episode out on time. But as I said, you never know. But either way, our automated stack will occur on time, and I will do the next episode, several episodes, as close as reasonably possible to our regularly scheduled DCA Wednesday timeframe. So along those lines, we will see you next week and every week while we keep building for our future. And until that time, keep on stacking those sats, you sexy sat stackers.